Venture Global just dropped a set of numbers that sent a shockwave through the entire energy sector. We're talking a report so powerful, it's got the bulls stampeding and the bears scrambling for cover. Welcome to Iron Financial. We're the channel that doesn't just skim the headlines, oh no. We take these companies into the workshop, and we stress test the steel beams that are supposed to be holding them up. So here's how we're going to do this. First, I'm going to be the lead analyst. We're going to build the bull case with all the powerful numbers driving this hype. Then we flip the script. I become the market skeptic, and we're going to grab a magnifying glass and hunt for every single crack in the foundation. Today, Venture Global is on the block. Are they forging a true energy giant, or is this whole thing just a shiny facade about to buckle under its own weight? Let's find out.
All right, let's just cut right to the chase. Before we get into any of the details, any of the noise, you need to look at this one number, 177%. No, that is not a typo. That's their full-year revenue growth for 2025. That is pure, unadulterated, top-line explosive power. We're talking about a company that jumped from $5 billion in revenue in 2024 to nearly $14 billion in 2025. You know, in the heavy-duty world of global energy and massive infrastructure, that kind of growth is almost unheard of. It's the kind of number that makes every analyst on Wall Street stop what they're doing, rip up their old spreadsheets, and start all over again. This single number is the engine behind the entire story. But wait a minute, hold on. The market sees that number and of course they start cheering. The stock pops big in the pre-market, you see the herd smells momentum and it just starts to run. But our job here at Iron Financial is to hit the brakes, take a deep breath and ask the really tough questions. And the biggest question of all for this company is right here. What is everyone missing? Come on, when you see growth this fast, this explosive, you have to ask yourself, is it even real? Is it sustainable? You have to get your hands dirty and inspect the foundation. Are they building a fortress designed to last for generations? Or is this just a fancy-looking skyscraper they're putting up way too fast? That's what we're here to figure out. Okay, let's get to it. We're going to start by building that bull case. To be fair, before we can start looking for cracks, you have to stand back and just admire the sheer strength of this thing. And that all starts with these blockbuster earnings. We're going to break down the raw numbers that have investors so fired up. And you know what? They have every reason to be. On the surface, these figures are just, wow, incredibly impressive. This is the story Venture Global wants you to hear. And believe me, it is a powerful one. So, what's really wild here is the speed of this change, especially in just the last 3 months of the year. I mean, just look at this table. Fourth quarter revenue up 192% from the year before. They almost tripled their sales in a single quarter, $1.5 billion to more than $4.4 billion. And then look at Adjusted EBITDA. That's basically a measure of a company's raw operational cash flow. That's up 191%. It went from under $700 million to $2 billion. See, this isn't just nice, steady growth. This is a company shifting into an entirely new gear. They're going from being a company that builds things to a company that operates them at full blast. This is the proof of a massive operational ramp-up. And you can't just brush this off. On top of all that insane growth, they also delivered an earnings beat. Their adjusted earnings per share came in at 41 cents when Wall Street was only expecting 35 cents. Now, the market absolutely loves a good earnings beat. It's a sugar high. It's an easy headline for the financial news channels to flash on the screen. But here, we have to stay disciplined. A single data point, one little earnings beat. That's not a foundation. That's just the first brick you lay. Now we have to find out if the rest of the wall is solid, or if it's actually full of holes. So think of this beat as the starting line for our deep dive, not the finish line. So let's talk about the materials they're using to build this massive wall. This next part is all about the hypergrowth engine. This is the absolute core of the bull argument. We're going to inspect how Venture Global is putting this energy behemoth together, piece by piece, brick by brick. We're talking about the cornerstone of their revenue, the powerful engine driving their profits, and the real-world, physical proof that this isn't all just some financial game being played on a spreadsheet. This is about building something huge, something that's meant to last. So what is the cornerstone holding this entire thing up? It is this number right here, $13.8 billion. That's their revenue for the full year of 2025. Just let that sink in for a second. This is the solid, steel-reinforced concrete foundation that the entire bull case is built on. A revenue base of nearly $14 billion gives you a massive platform to build from. This is not some small-time exploration company hoping to strike it rich. This is a major global player, and this number proves it. This is the kind of revenue that gives you serious power at the negotiating table. It's the anchor of the whole operation. And okay, if that revenue is the solid foundation, then this number, this is the power plant. $6.3 billion in full-year adjusted EBITDA. And listen, this isn't just some abstract accounting term. This is the cash-generating engine roaring away in the basement of this entire building. It's the machine that turns all that top-line revenue into the hard cash you need to pay down debt, to fund new massive projects, and eventually to reward your investors. An EBITDA that's almost half of your total revenue, that shows incredible operating leverage. It means for every buck that comes in the door, a huge chunk of it is turning into pure operational profit. That engine isn't just running, it's running hot and it's running efficiently. But look, this can't all just be about numbers on a spreadsheet. For a foundation to be truly strong, it needs to be tied to real-world results. And here they are. 380. That's how many cargoes of liquefied natural gas they physically exported in 2025. And get this, that's up a jaw-dropping 170% from the year before. This shows you that the financial growth is being driven by a massive, real-world increase in operations. We're talking about giant ships, each one filled with energy, sailing to 38 different countries around the globe. This is the operational horsepower that proves this company isn't just booking sales. They are physically delivering the goods on a scale that is growing at a crazy pace. And if somehow those individual numbers didn't hit home, this chart just hammers the point home visually. I mean, just look at the sheer scale of this jump. On the left, you've got $5 billion in revenue for 2024. Now look at the bar on the right, nearly $14 billion in 2025. That is not a step up. That is a quantum leap. It's the difference between putting up a big office building and constructing a super tall skyscraper. This is what forging an energy empire looks like on paper. The pure vertical climb of that second bar is exactly why the market is paying such close attention. Okay, an empire, maybe. A skyscraper, perhaps. But you know what? Even the strongest empires eventually fall, and the tallest skyscrapers can have hidden structural flaws. A shiny glass exterior and a powerful engine are great, but now it's time for the real stress test. Now we're going to look for the cracks in the armor. So we're pivoting. We're taking out the magnifying glass, putting on our hard hats, and we are going to conduct a much, much deeper inspection of these financials. We're hunting for the weaknesses that the rest of the market, in all its excitement, might be totally ignoring. And our inspection, well, it starts with this very simple but absolutely critical question. This is the first thing that should set off alarm bells for any serious analyst. We just saw revenue rocket up by an incredible 177%. So if the company is bringing in so much more money, why did the bottom line, the actual profit that shareholders get, grow by so much less? This huge disconnect, this is the first and most obvious sign that something under the surface is acting like a massive anchor, creating a drag on the company's profitability. And this right here visualizes that problem perfectly. It really is a tale of two different growth stories. Over on the left, you have that beautiful, powerful 177% revenue growth. That's the story the bulls want to tell you. But now look to the right. Net income growth for the full year was only 53%. Now don't get me wrong, 53% growth is fantastic for most companies, but it's a long, long way from 177%. The gap between those two numbers is absolutely enormous, and it represents billions of dollars in potential profit that just, poof, vanished somewhere between the top line of the income statement and the bottom line. This is the first hairline crack, and it demands that we take a much closer look. So where did all that money go? What's causing this massive drag? Well, it's not just one thing. It's a whole combination of heavy loads weighing the structure down. First, higher interest expense. That ate up an extra $870 million. Then you have these complex things called interest rate swaps. Think of them like an insurance bet on which way interest rates will go. Well, that bet went the wrong way on paper, and it cost them nearly $1 billion. On top of that, their own operating and gas costs are going up as they get bigger. And here's the kicker. The prices they were getting for their LNG at one of their key projects were actually lower. So think about it. Your financing costs are up, your operating costs are up, and your pricing power is down. That is a dangerous, dangerous combination. And now for what might be the most important test of all, the balance sheet. This is the bedrock. This is the literal foundation of the entire company. And when we apply our stress test here, we find the second major crack. Look at their cash. It's gone down a lot, from over $3.6 billion to just $2.3 billion in 1 year. They burned through more than $1 billion of their cash safety net. And at the exact same time, look at their long-term debt. It has ballooned from $29 billion to over $33 billion. Let me be perfectly clear about what this means. They are funding this empire by burning through their savings and piling on a mountain of debt. That is an incredibly high-risk strategy that leaves you with zero room for error. And hey, don't just take my word for it. This isn't just our interpretation. The company itself is waving a little red flag. Just look at this direct quote from their guidance for 2026. They are telling investors point blank to watch out for margin compression in the first quarter. That means their profitability is about to get squeezed. Now, they're blaming a winter storm and other things, but the message from them is clear. The party might be winding down. The easy, high-profit growth period might be over, and the road ahead is going to be tougher. When a company's management team warns you that profits are about to get tighter, you had better listen. Okay, those are all very solid, very real concerns. The debt is heavy, and the margin pressure is a real threat. But a good skeptic might be focusing too much on the balance sheet during the peak construction phase. Of course, the finances are going to be stressed when you're building something this massive. You have to look at what they are building with all that debt. And that brings us to the core of the bull's rebuttal. They are using that debt to lock in the future. All that leverage isn't just for show, it's being used to build the infrastructure that will secure guaranteed cash flow for decades. Let's look at the proof. See, this isn't growth based on the wild, volatile, daily prices of natural gas. No, they are de-risking this entire business by signing these ironclad, long-term contracts. Just look at this. They inked a massive 20-year deal with Hanwha Aerospace in Korea. That's guaranteed revenue for 2 decades. They signed another 5-year deal with a huge commodities trader, Trafigura. All in all, just since the start of 2025, they have locked in almost 10 million tons per year of new sales. That mountain of debt on the balance sheet is being systematically turned into these bulletproof, long-term streams of cash. And this image shows you exactly what I'm talking about. You see this massive ship docked at their facility? That is the physical result of those paper contracts. The debt they took on built this terminal. This terminal turns the gas into liquid, and this ship delivers that liquid gas to a customer who is legally bound to pay for it for years and years. This is how you turn a liability on a balance sheet into a real, tangible, cash-generating asset that works for you day in and day out. This is what a durable, long-lasting business actually looks like. And the guy in charge, CEO Mike Sabel, is projecting nothing but pure confidence. He's not focused on short-term margin warnings. He's talking about an even more productive year in 2026. He's out there setting a target of exporting over 500 cargoes next year. That's a huge jump from the 380 they just did. The message coming from the C-suite is crystal clear. The growth engine is not sputtering out. It's just getting warmed up. The heavy construction phase is ending, and the massive cash generation phase is about to shift into overdrive. Which brings us to our final and most crucial section, the iron verdict. We've laid out the bull case, a case built on a foundation of explosive revenue growth, all secured by long-term contracts. And we've laid out the bear case, which points to those hairline cracks, massive debt, slowing profit growth, and those warnings about the future. So it's time to put all the evidence on the scale and make a call. Is Venture Global a fortress, or is it just a facade? So let's lay it all out right here, side by side. The bull case is resting on these massive steel beams, that undeniable 177% revenue growth, and that even crazier 198% adjusted EBITDA growth. It's all supported by those newly signed long-term contracts and the real-world momentum of shipping 380 cargoes. But on the other side of the scale, you have the structural weak points, the hairline cracks that could get wider under pressure, the fact that net income is growing so much slower at 53%, the enormous and growing mountain of long-term debt, the fact that their cash safety net is getting smaller, and of course, the company's own warning that their profit margins are about to get squeezed. You simply cannot ignore either side of this table. So here's the bottom line. This is not a simple story. This is not your grandmother's safe utility stock that pays a steady dividend. No. This is a high-leverage, high-stakes bet on the entire future of global energy. The growth is absolutely, positively, undeniably real. You cannot argue with those top-line numbers. But the structural risks, the debt, the margin pressure, the sensitivity to interest rates, are just as real and just as significant. So what's the final verdict from us here at Iron Financial? After putting this company through our toughest stress tests, after inspecting all the steel beams and analyzing every hairline crack, we see this as a structural opportunity, but, and this is a huge but, it is an opportunity only for investors with a very high tolerance for risk and a long-term view. The amount of debt is serious and there is going to be volatility. But the sheer scale of this growth, their proven ability to pull off these massive projects, and the security of those multi-decade contracts, it all creates a powerful case for massive future cash flow. They are forging an energy giant, but let's be clear, the process is going to be loud, it's going to be hot, and it is definitely not for the faint of heart. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.